The S&P 500 has made millions of Americans wealthy, but with inflation still sticky, layoffs in big tech, and rising interest rates, is it still a safe place to put your money in 2025? A lot of people are worried right now, and rightfully so. You've seen your portfolio dip, you're hearing analysts talk about market bubbles, and maybe you're thinking about pulling your money out entirely. But before you make any moves, let's unpack the full picture. How the S&P 500 works, what's changed in 2025, and whether it's still worth investing in today. If you're thinking of ditching the S&P right now, this next part might save your portfolio. First, let's quickly recap what the S&P 500 really is. It's an index that tracks the 500 largest publicly traded companies in the US. It represents roughly 80% of the total US stock market. That means when you invest in the S&P 500, usually through ETFs like VOO, SPY, or FXAIX, you're instantly diversified across sectors like tech, healthcare, finance, energy, and consumer goods. You're not betting on a single stock. You're betting on the US economy as a whole. Here's why Warren Buffett still tells everyday investors to go all in on the S&P, even in 2025. Over the past 50 years, the S&P 500 has delivered an average annual return of 10.3%. But that doesn't mean every year is smooth sailing. Let's look at some data. 2008, the market dropped over 38%, but it rebounded the next year. 2020, COVID crashed the market by 34% in 1 month. It fully recovered within 6 months. 2022, inflation, supply chain issues, and war in Ukraine dragged the S&P into bear market territory. 2023, fueled by optimism in AI and cooling inflation, the S&P bounced back with a 24% return. So yes, volatility happens, but over time, the index always recovered and rewarded long-term investors. This is why trying to time the market is the number one way people lose money. Fast forward to 2025. Here's what investors are dealing with. Inflation is still hovering around 3.4%, higher than the Fed's 2% target. Interest rates are at a 20-year high, which makes borrowing more expensive and can cool economic growth. Tech companies like Google, Meta, and Amazon have laid off thousands. Geopolitical tension in Taiwan and oil market instability are adding global uncertainty. All of this makes people nervous. But ask yourself this: is this the end of American capitalism, or just another cycle like 2008, 2020, or 2022? Here's what the data says about market recoveries after major uncertainty. If you're going to invest in the S&P 500 today, here's how to do it wisely. Use low-cost ETFs like VOO or FXAIX. They mirror the index with minimal fees. Start with fractional shares if your budget is limited. Practice dollar-cost averaging, DCA. Invest a fixed amount weekly or monthly, no matter what the market is doing. Turn on dividend reinvestment. Don't let that cash sit idle. This helps you build wealth without trying to guess market highs and lows. Even in 2025, this exact strategy beats 90% of Wall Street pros over the long run. The S&P 500 is a powerful foundation, but it's not your whole portfolio. If you want broader exposure, consider total market funds like VTI, includes mid and small cap stocks. 2 international indexes, VXUS, IEFA, for global diversification. Small cap funds, like IJR, riskier but with higher upside. This gives you exposure to areas the S&P 500 misses, especially in emerging markets or growing sectors. Final words. The S&P 500 is not a hype train. It's a long-term vehicle. If you can ride out the bumps, it still gets you to your financial destination. I've linked a free index investing guide below. If you want real investing strategies that actually work, hit subscribe, and I'll see you every week.